Hey everyone, in this video we're talking about SPY versus SPY. That's right, will selling covered calls on SPY, the S&P 500 index fund, outperform simply buying and holding SPY? I previously published a video that introduces this concept. I'll put a link in the description below and in this video so that you can go over and check that out first and then come back to see how I'm executing that plan. First step in this strategy of selling covered calls against SPY is to own 100 shares of SPY. So I could simply buy 100 shares at the market price, or I could sell a cash secured put at a lower strike price, collect some premium, and obtain those shares at a lower price than what SPY is trading for now. And as you can bet, I went for the second option, sell cash secured put at a lower strike price. In this case, the strike price was $3.79, and I received $1.99 per share in premium for selling cash secured puts. That's right, it wasn't just one put. Things got a little complicated. I sold the put on January 15th for 87 cents, and then I rolled and rolled and rolled and rolled again. When all was said and done, I received $1.99 in premium because I ended up getting assigned. And I was assigned at that strike price of $3.79. But because I received $199 in premium, effectively, I own these 100 shares of SPY at around $377. And that's because I was assigned the shares at $379, subtract out the $1.99 in credit that I received, and that leaves us with $377 per share. So I'm already off to a great start. Just simply on trade entry, I'm already up. So then we move on to step 2, selling covered calls. And if everything goes according to plan, this step is gonna go on for a long time. I'm gonna be selling covered calls over and over again. So I did sell my first call for $1.48 in credit on January 20th. Later that same day, I rolled it for another $2.70 in credit and ended up with an average trade price, a total credit of $4.18. And that just gets added to my $1.99 as far as lowering my cost basis on my shares of SPY. I sold a $3.88 call that expires on February 19th. So as long as SPY stays below $3.88 by February 19th, then I will keep that entire credit of $4.18. Add the $4.18, and that's a total of $6.17, which means I will effectively own the shares at $372.83. That's taking the price at which I was assigned the shares, $379, and subtracting the credit that I will have received, $6.17, bringing my cost basis down to $372.83. And by the way, SPY is currently trading at $383.79. So once again, off to a good start. So if you're wondering what I'm gonna do with the credit received, well, if you watched the previous video, you'll know that I'm going to actually put it into a separate investment in the same account, VTI, that's Vanguard's Total Stock Market Index Fund. That's the fund that I was invested in originally when I had this money over at Vanguard. I transferred it over to Tastyworks to run this covered call strategy on SPY, but any of the premium I receive is going to go into building up my position in VTI alongside my SPY position. Once there's enough assets in VTI to buy 100 shares of SPY, my plan is to go ahead and sell, buy another 100 shares of SPY, and now I'll be able to double up on this covered call strategy and sell 2 covered calls at once. Pew, pew. So just to reiterate, what I think is the key to this strategy is to not get assigned. I'm gonna hold my shares of SPY, sell out of the money covered calls, but if the price of SPY rises too close to that covered call price, I'm gonna start rolling it out in time. And because this is a buy and hold forever type of position, it's not a problem. I could roll out a week, roll out a month, roll out 2 or 3 months if I have to collect more premium, and importantly, to avoid assignment. Because the whole gotcha with selling covered calls is that they say your upside is capped. So that in this instance, if SPY rose way past my covered call price, I miss out on all those gains above the covered call strike price. But if you can avoid assignment, that's not an issue. And you enjoy the performance of SPY, all the dividends, but then you also collect premium here and there along the way. So the key is don't get assigned, always be rolling. Don't get assigned, always be rolling. Don't get assigned, always be rolling. ABR. roll up in strike price, roll out in time, whatever you need to do to get away from the share price and to avoid being assigned and avoid capping your gains. So this is just the beginning of this strategy and this experiment, I guess, in SPY versus SPY. And over time, I'll find out if selling covered calls on SPY is going to outperform simply buying and holding SPY. And my plan is to do periodic updates on this SPY versus SPY and let you know how it's going. If you have any thoughts on this strategy, please drop them in the comments below. Remember to subscribe to this channel. Thanks for watching.